Good Tuesday morning. I'm Yahoo Finance Executive Editor Brian Sozzi, and this is Opening Bid. What's on my investing mind today, you're wondering? Is it Meta's $2 billion deal for Chinese AI company called Mantle made during a slow holiday week? Nope. Or how about the Fed minutes out later today? Definitely not those Fed minutes. It will never be VIP to me. It just won't. I'm not a fan of Fed minutes. What's on my mind is one mythical investing creature, actually. That creature is the Oracle of Omaha, Warren Buffett. 95-year-old Buffett will hand over the leadership reins to his hand-picked successor, Greg Abel, on Wednesday. The official passing of the torch caps a storied, decades-long investing career for Buffett, one where he did everything from buy a major U.S. railroad in Burlington Northern, strike up a friendship with Microsoft co-founder Bill Gates, and offer up scores of pithy comments in annual shareholder letters. Through it all, Buffett championed the art of value investing as taught to him by mentor Benjamin Graham, which is rooted in an unwillingness to overpay for acquisitions or stock investments. Naturally, along the way, Buffett developed a favorite investing indicator or two. One of them is the Buffett Indicator, as it's known by devoted followers of the Oracle of Omaha. The indicator takes the Wilshire 5000 index and divides it by the annual U.S. GDP. Picking apart the numbers today, the Buffett Indicator stands at about 221.4%, up a sharp 22% from April 30th, according to data from Guru Focus. The indicator has never been at a higher level, dating back to the earliest data from Guru Focus in 1970. So what should investors take from this and more broadly from Buffett's career? Here in the Opening Bid Roundtable, Max Wasserman, Miramar Capital co-founder and senior portfolio manager, alongside Yahoo Finance senior reporters Brooke, DiPalma, and Ines Ferré. Max, coming to you. You heard me talk a lot about Warren Buffett there. What do you make of his indicator? Because I went back and it's been overvalued for the past couple of years, in part because of this AI boom. Should you just be ignoring something like this?
Good morning, and I believe no, but then I'm biased because I've been a student of Benjamin Graham. That's how I learned in graduate school and undergrad. I think it's telling you that this market is very richly valued and that the risk, the asymmetrical risk, may not be in your favor when you're looking at indexes. I mean, it's individual stocks that really count, that make up the portfolio. But when you look at the broad index, I think this tells you that the market is overvalued because it is heavily concentrated in a handful of stocks. I don't believe if you took out those handful of stocks that the market would be as richly valued. But clearly, I think the Buffett Indicator tells you that given where we are with valuations, you got to be careful for that asymmetrical downside versus the upside.
Max, if on the long list of things to be worried about for next year, from AI overexpansion to what happens to Fed policy, you name it, or even if tariffs are back in play come January and SCOTUS decision, what is your top concern and why?
My top concern is inflation. If the Fed turns out to be moving one direction and the administration wants to go in another, if we see that inflation is more stubborn and that we continue to cut interest rates, which it looks like we believe they're going to do at least another 50 next year, you could get a environment where the dollar gets very weakened and you could get sort of like a stagflation, and that takes more risk in the market and that creates uncertainty. So I think inflation is probably my number one, and especially too quick of expansionary monetary policy. I don't see the need for this type of aggressive cutting given where the economy is.
Ines, you and I have covered Warren Buffett for many years, and he has always said not to bet against America. And to his point, look at where this country is now. The AI infrastructure boom is very much live and well. I imagine that's benefiting his Burlington Northern Railroad.
Yes, I mean,
look, go ahead, Ines.
Yes, look, AI is definitely what Wall Street has been focused on when it comes to the market and when it comes to price targets for next year. As far as Warren Buffett saying not to bet against America, yes, I remember him saying that so many times also during the pandemic as well. Berkshire Hathaway has now bought Alphabet, so it is within the AI trade. It has also Apple in its holdings as well. I mean, just taking a look at some of the stocks that they've acquired as well: Chubb, Amex, Oxy, Chevron. So this is a company that has done very well for itself under Warren Buffett's leadership. And I will say that, as his leadership comes to a close and he hands off the baton to Greg Abel, what strikes me the most, beyond just his pearls of wisdom that he constantly has given investors, is also his kindness. And in the Thanksgiving shareholder letter that he wrote, he put it, kindness is costless, but also priceless. And he said, keep in mind that the cleaning lady is as much a human being as the chairman. I think that his legacy will be not only a great investor, but also a kind investor. And in a world where there is so much conflict, meanness, and everything else, that speaks volumes to his leadership.
Ines, what are you trying to make me cry? I'm a pretty stoic guy. I mean, what do you do to me, Ines? It's Monday, it's Tuesday morning, come on.
It's true. I mean, when Warren Buffett comes to mind, that comes to mind. And that letter to me was, I thought to myself, this is gold. I mean, these are golden pearls of wisdom.
Damn, I'm getting all emotional now. Brooke, I have this story on this Buffett Indicator now in Yahoo Finance, and I was chuckling a little bit as I put it together because it has been overvalued for years, especially the past 2 years. And I came away thinking this indicator, we're showing there on the screen what it's all about, this Buffett Indicator, could stay overvalued for more years.
Brian, we had a guest on Stocks in Translation yesterday, the podcast at Yahoo Finance, and when we spoke to this guest, she was largely saying that if you take a look just at valuation over the past 3 years and you didn't choose to jump into the market, then you would have missed out on this 3-year bull run. Many expecting that next year could be the 4th year of this bull market that we've seen so far. And so while, yes, the Buffett Indicator is overvalued, many are saying that this market, the valuations are too high. If you missed out over the past 3 years, then you missed out on this 3-year run and what could be another 4th year of the bull market that we've seen. And also we're hearing so much from different outlooks for 2026 about where exactly the S&P 500, even as high as 8,100, is 1 year-end target for 2026. And so more momentum is expected to come. And so yes, there are high valuations right now, but what we've seen over the past few years is really these continued momentum proving that overvaluation saga wrong.
Max, I love this on the notes that you sent over to us. You said you were very cautious on the OpenAI trade. And I thought, well, does that mean investors should be betting against AI stocks at this point?
Well, I don't look at investing as betting, but I think they have to be aware of where they're going to get the returns. So yes, I'm very cautious. We have investments in OpenAI. I'm just not in OpenAI, but we have it in the Googles, the Microsofts, and all those. But I would be cautious on the financing aspect of OpenAI, the circular financing. And given the concentration, you need to diversify the portfolio and you need to understand what you own and what happens if you're wrong. So if this trade goes south, it's going to take the indices with it. I don't think the general market, again, is as expensive as this concentrated part of the market. But yes, I think there's risk there, and I don't think you're going to get these double, triple digit returns like you have. And I think you have to go to other parts of the market. And going back to the Buffett Indicator, keep in mind, that's just an indicator. He was an investor in stocks. And he's telling you to really know what you're buying and don't overpay for it. That's really what he was saying by that indicator.
That is a good point. Max, I feel we spent so much time here talking about the Mag 7, and one of the stocks that doesn't get enough attention, in my view, is Broadcom. You like Broadcom. You have a large investment in Broadcom. What is the case for them, and how do you see them performing next year?
Well, I think Broadcom was a little misunderstood. We were big buyers of it during COVID, actually, when it was giving you over a 3% dividend yield. So, we like dividends. So what I like about it is the VMware side of the business and their programmable side. These are very specialized chips. So not competing as much with NVIDIA. I think they're creating their own market. And I think their growth rate and the ownership has been tremendous. But again, we've been trimming this position because it grew to so much in our accounts. I mean, we had up to 7% of our portfolio. We didn't want that much. We still like it, but we're not expecting the 50, 60% return. We'd be very happy with Broadcom about 10%. But we like the program and the specialization of the chips, and we like the VMware, which is now 45% of the revenue. So it's a more software base as well. So we like that as much.
And Max, hard turn here. You also are focused on dividend growth and like Home Depot and McDonald's. Now, Home Depot has struggled this year for various reasons. McDonald's has done okay. Do you have to have both of those names in your portfolio, given where the consumer is here right now, in many cases struggling?
Sure. And do you have to have them? We like them. We think it's asymmetrical. You look at our portfolio as more of a barbell. We have about 24% in technology, and then we have the rest in these. And we think lower interest rates should help the housing market. And McDonald's is a specialty. So we think that appeals to the low-income investor, the middle class, who is very frugal with their money given the economy. Home Depot, we think as you go into spring, lower interest rates should help them. And keep in mind, about 45 to 50% of Home Depot is now professional, so it's less as sensitive to the individual consumer. And given the fact that these stocks haven't really performed, they're giving you 2.5% dividend, good growth. We think it's an excellent place to be in conjunction with the technology stocks.
Brooke, you cover McDonald's for us. What's on their plate for next year? No pun intended.
Well, certainly I'm looking to see how value plays out in 2026. That was the name of the game, especially to get those low and middle income consumers to come into their stores once again after they pulled back a bit because they thought that the food was just too high of a cost these days. And so we've seen that $5 menu really work for them. We've seen innovation work for them, that snack wrap, and we'll see if that continues to be the case in 2026. And when I spoke to an analyst that covers more so retailers like Home Depot, like others, what he actually told me was we've seen this K-shaped economy persist over the course of 2025, but now he said it's more of a alligator shape. He said that the lower end that we've seen, that lower part of the K has actually gone up a little bit with that low and middle income consumer getting a bit of a swoon moving into 2026. We have those tax returns that are largely expected to see a boost of consumer spending. Also, the consumer has really outperformed this holiday season compared to especially what we thought would be the case back in April and over the course of the summer. And so we're seeing that low and middle income consumer sort of hold up in this environment, but they definitely are still seeking out value, and that's been a bit of a boost for McDonald's.
The alligator-shaped economy? Brooke, I've never even heard of that before, but I like it.
Joe Feldman, Telsey Advisory Group, told me that. I
dig it. Inez, let me get over to you real quickly on this last one. Max also likes Home Depot, and I'm thinking about Home Depot. I'm thinking about their aisles. I'm thinking about copper. I'm thinking about various metals. And I am a little concerned on the margins Home Depot might look like next year because of this rise in commodities, Inez.
Look, the rise in commodities is so significant when it comes to all these metals that are used. I mean, you have copper that is very much used in construction, in home construction. So it's not just that you're talking about the precious metals, but you have pretty much the metal basket that has gone up going into next year. And as far as copper is concerned, even Goldman Sachs says that it's their favorite industrial metal trade for next year, for 2026. So it is expected to go up beyond the high prices that you've seen. This could have so these input prices could have a squeeze on margins for companies as well. The one thing is, as I was talking to one strategist, the cure for high prices is high prices. I mean, you will have some demand that pulls back if the prices get just too high.
Yeah, if my drill prices go up to $500, I'm just going to leave the drill there in Home Depot or Lowe's. I'm just not buying it. All right, well, good to see you all. Max, Brooke, and Ines. We'll talk to you soon. Appreciate it.
Thank you. Happy New Year.
Thank you as well. Coming up on Opening Bid, I revisit my chat on AI with Reddit co-founder Alexis Ohanian. I'll be right back with that one. The main market driver of 2025 has no doubt been AI. From blowout NVIDIA earnings to product stumbles at OpenAI, it has been a year of twists and turns for the AI trade. I caught up with tech investor and Reddit co-founder Alexis Ohanian at Yahoo Finance annual Invest event. Here's how he is thinking about the AI revolution. You're a father of young children. What is this AI revolution? What will it mean to how they learn? But in addition, what does it mean for that generation, their ability to find jobs 15, 20 years from now?
Well, okay. So on the latter point, I don't know. I want to believe I'm a tech optimist, and I do think more new jobs will be created than removed from the system. I think an easy example, we were fortunate to be early investors in a guy, Mr. Beast, 5 years ago. The idea of being a content creator, let alone a billionaire because of it, was unthinkable, 15 years ago, 20 years ago? And now it's probably one of the most common professions that a young kid, at least in America, wants to be when they grow up. So there is precedent, right, for, social media. That revolution was a significant one, not nowhere near as big as AI, but it was one that created entirely new career paths, sectors, industries that didn't exist before. And with every technological revolution, there's always new careers, new things that come up that you or I can't necessarily think of. The builders are going to build and do. And so I'm hopeful there are going to be more new ones created. We actually just in DC with one of our companies, Area 2 Farms, where they're franchising vertical farming. And when they talk about what is needed to manage a vertical farm, especially in a dense urban area, where you don't have a lot of space, and because it's more vertical, you're going to have a whole new trades of people who are working on the robotics that help manage those farms and make sure the lettuce, grows on time and whatnot. And so again, we're already seeing AI, robotics, they're two sides of the same coin, creating new jobs, new opportunity, new innovation, better quality of life, right? Everyone deserves access to high quality, well-grown produce, right? Whether you live in a rural community, whether you live in a city. And so I feel like it'll be a net positive. That doesn't mean it won't be a bumpy road. And, how do I prepare my 8-year-old and a 2-year-old for this? I've already been paying attention. I've been tweeting about things like Alpha School, which I think are taking a really smart first principles approach to education. I do think the future of education for, let's say, K through 12 looks a lot more like having guides instead of teachers, and that's verbiage from folks like Alpha School and Prenda, where your personalized AI tutor is doing a lot of the instruction, right? I'm a big Duolingo user. You're familiar with that. That is probably the
great platform
expression of that, right? And there's no reason why a kid, regardless of their background, regardless of their home life, shouldn't be able to get personalized education. So if they need extra help with a certain part of math or a certain part of English, fill in the blank, you're going to have AI solve those problems for them, giving them that infinite access and infinite patience to support and customize learning. And then hopefully those kids get to spend the rest of their school day actually interacting and building up their emotional intelligence and solving problems. And I think the school of the future should really optimize the time with the AI to help learn, but also maximize the time off a screen so that kids are getting the things that are going to continue to be valuable when they grow up.
Alexa, let me channel the sports side of your brain. And earlier on today, I had a really good chat with Ted Leonsis, owns the Wizards, several other teams. His portfolio is valued at, I believe, close to $8 billion. We mentioned the Lakers, valued at close to $10 billion. You have been an early supporter, investor of women's sports. When in the world is this valuation gap closed between women's sports and some of these mind-blowing valuations on the med side of the equation?
Look, it's coming quick. My tweet about how undervalued women's professional sports was in March of 19 went viral for all the wrong reasons, right? I said this is a massive opportunity. I said I was going to either start or buy. It was an NWSL team, professional women's soccer team, and one day it was going to be worth billions. And most people said I was an idiot and no one watches women's sports and that'll never work. And I said, save those tweets. And he ultimately paid a little over $1 million for the expansion fee to start Angel City FC. And in the wake of that success, right now it's valued at the most for any American women's soccer team. Arthur Blank in Atlanta just paid, I think, $160 million for his expansion fee. So that's quite an appreciation over just 5 years. And so it has been really validating to see, to call the shot, to spark that and see the growth. But I think anyone will tell you it's just the start. There is so much more room to grow. And remember, most of these men's teams' value is based on media deals that have been baked over decades. And, whereas for women's sports, when we're building a team, I just bought the LA franchise of League One volleyball. And it was just like 2 weeks ago, so hot off the press.
Congrats. Wow.
We build out, thank you. When we build out the structure for how to build that team, most of our revenue is not going to come from a media deal. Most of our revenue is going to come from brand deals. And so we've been able to build, Angel City's doing tens of millions of dollars in revenue a year. You're seeing a precedent here for more and more women's pro teams to basically build the muscle of revenue generation in a way that's much more about, business, right? It's about how do you drive revenue through brand partnerships and all these things that it turns out lots of CMOs are excited by. And the media deal is still down the road. So you have to earn that media deal through the viewerships, but the brand dollars obviously help you build the brand and prove the value. And it's this virtuous cycle. And you've seen that in the rapid ascent of WNBA team valuations and revenues. And I think, it won't be for every sport, but you can see the places I've been investing, obviously also starting a Formula One for track and field like Athlos. That's an entire league where I've seen this same opportunity that I saw with women's soccer, where the World Cup showed up every 4 years and then everyone was watching and then they all disappeared. The thesis was simple, why not make sure they don't disappear and keep investing? Similarly, track and field is the #1 Olympic sport. these athletes are superstars and then they disappear. They shouldn't disappear. So we built Athlos, and 4.5 million people tuned in for our New York meet just a month ago, and we're rolling out a multi-meet league next year with teams. So I'm excited about all this. I think at the end of the day, we're only 5 years away. I think 5-6 years from my tweet. And I think there is still so much more room to grow in women's sports. I think we will absolutely see billion-dollar women's sports teams, as I had laid out, and I will be sure to rub that in the face of all those haters on Twitter 6 years ago.
Last one, and I wanted to save this one, Alexis, because I think this is also in your wheelhouse, and it's also in the wheelhouse of my dear friends at Yahoo Sports. Why are collectibles having a moment, and what is next in this industry?
It has been an amazing ride. We love our partnership with Mantle and Yahoo. We've got some hobby awards right now, actually. I think this industry is starting to professionalize, right? The hobby was always a very mom and pop type business. And during COVID, everyone was locked down. Everyone was feeling pretty anxious, and nostalgia became really, really desirable. And so that's when I got back into the hobby. I collected cards as a kid, like a lot of kids in the 90s. I thought that collection was going to help me retire one day. It did not.
That does it for Opening Bid. And before we go, I just want to take a moment to wish Tiger Woods a very happy 50th birthday. I can't believe he is 50. I was just playing his video games, I feel, on the PlayStation 2. Wow, time flies. Coming up, Jared Blickery has you covered on Market Catalyst. Don't go anywhere.